Hello, hello.
We're here. I know we didn't post earlier that we were going to be here, but we are here.
We are here.
It's been a bit of a whirlwind of a morning, so we didn't get around to posting, so I apologize for that. Um, but we had a whirlwind of a morning for a good reason, because we were up late last night. Um, we had some meetings with our partners for the 24 unit that we are closing on in a couple of weeks.
Mm-hmm.
Just some final stuff. It's always that final stretch that's a little bit extra crazy.
Got to get those ducks in a row.
Yeah,
Cross
so
the T's, dot the I's.
yeah, the ducks were took a little bit longer to get them in a row last night, so we were on a meeting until about 12:30 today, I guess, this morning.
And then up nice
Technically,
and early for a little morning workout. So
yeah. So so it's been a bit of a crazy morning, but anyways, so yeah, lots happening with the projects we have going on right now.
Mhm.
24 unit is looking great. I know it like I said, final stretch is always a bit crazy, but everything is lining up.
Yeah.
So
Conversions
knock on
are
wood.
moving along nicely as well.
Yeah.
So that's a lot of fun.
Yeah. So that's going on, and
So
I think what?
what's new with you?
Oh God. All
It's our
right.
topic.
That's how we're
This is new.
starting.
I have a new jacket.
New is nice.
Yeah.
New
It's
is
soft
always
and
good.
stretchy, actually. It feels like sweater.
Yeah, it is
It's very soft.
sweater
It's
material.
warm and I was cold this morning, so this jacket was nice.
It is chilly.
That's what's new with me.
So yeah. Anyways, it's a nice kind of segue
Wow.
into what we're talking about today, I guess.
I'm just gonna drink my piping hot coffee.
If you are new to watching our lives today, welcome. If you've been watching them pretty consistently, welcome back. As always, we like this to be as conversational as possible. We have a couple of things that we want to touch on, but really it's just going to be us kind of bantering back and forth.
Yeah, we kind of have some bullet points and some ideas on what we want to say, but we want this to be engaging. We want you guys to drop your comments and what do you feel about maybe the topic at hand, which today's topic is new builds.
Yeah, because I think a lot of people skip by new builds because they look expensive. I think you get used to an amount per door in an area that you are okay with paying. You know, like the area amount per door is kind of what your typical amount is, and then you see a new build and you're like, whoa, it is double what my typical per door amount is for that area.
Yeah.
And people tend to just kind of pass by them because of that. But there are a ton of
Benefits.
a ton of benefits to buying a new build, and this is something that we've discovered definitely in the last year. We've seemed to be very attracted to the new builds.
Yeah, the very first big multifamily deal that we got under contract was a brand new. It was built 2021, and this was 2022.
Yeah, I think it
It
was
was
just
early 2022 that we got this under contract. So they just finished building it, had it fully tenanted, and then the builder was selling it because they like to build. They don't want to buy and hold, essentially. So they're just wanting to build. So they had it up for sale. We got that under contract. That was the very first deal that we got under contract, was brand new 16 unit building.
Yeah, and since then,
that's pretty much all we've looked at. I don't know why. We're not scared of renovations. We've done plenty of renovations with our flips and our secondary dwelling unit conversions, adding units. Like, none of the permitting with the city, none of that scares us. But there was just this, I guess, attraction to new builds because they're nice to look at. There's a lot of benefits that are behind them. You get the pick of the best tenants.
Yeah, I think that's a good point to kind of start off with, is that, there's a lot of concern in Ontario about, tenant profiles and what tenant, are you picking the right tenant? Are you putting the right tenant in the right place? Because there's there's a lot of landlord tenant horror stories in Ontario, and that's a whole other topic that I can go on about for a while, and how unfortunate that is.
Maybe that's a
Maybe that's
topic
another
for
topic.
another
I don't
for
know.
another
It
lunch
makes me
or
really sad
power
that
lunch.
it exists, but it is what it is. Uh, but I think with that, if you're investing in Ontario, you're trying to get the best tenant profile possible, because if there are any issues, it's hard to evict a tenant that isn't working out well. With a new build, you tend to get a pretty good selection of tenants because people love living in a new build. People are willing to pay a little bit more for living in a new build. So you end up getting good, above almost typically market rents, above market, good solid tenants.
If it's brand new, they'll pay extra to live there, right? You have that premium to the rent.
Yeah. So you end up, making potentially a little bit more than you would. So yes, your per door is above market, but so are your rents.
Yeah.
So it often ends up working out in a nice way.
Yeah, and often end up outperforming buildings that maybe you've done a burr on, or that you're just buying and holding, but it's an older building. We'll say anything pre 2018.
Yeah. So why do you think they outperform then?
There's a few reasons, but one big reason is, especially in Ontario, rent control. Mm-hmm. So these buildings, anything built in Ontario after November of 2018, it does not fall under rent control. So
as of right now, as of whatever date is August 15th, 2023.
I think previously I heard, I don't really know, but I think previously it was 2012 was considered the new. And then that got updated to 2018. So if it's built beyond that, then until they change the rules again, there is no rent control on buildings that have been built, or new units occupied for the first time as residential. They don't fall under rent control. So that means that we aren't tied to, like, 2021, I think, was 0% increase for landlords.
Yeah, there were some zeros, there were some ones. Like the 2.5 was a fresh of breath air, and fresh of breath. Oh gosh, guys, I'm tired. Breath of fresh. I was like, something didn't sound right there.
Yeah, 2.5%
fresh air
isn't even close to inflation. Yet we're here in Ontario saying yes, we can raise rents 2.5%.
We were at, I think, 8% inflation when they did the 2.5, and everybody was super excited that they could raise rents by that much. Yet it wasn't even keeping up with inflation.
Yeah,
obviously things are a little slowed down a little bit right now as far as inflation goes, for the most part, but still, like, 2.5 is pretty minimal as far as what inflation looks like in Ontario. It makes things tough. So being able, and it's not necessarily that you want to just like pump up rents, $1,000 a month every year and push your tenants out, but at least it gives you some flexibility to keep closer to market.
Yeah, and that's actually an important comment. So you can't actually upgrade or increase the rents whenever you want. You still have to follow the guidelines, but you don't have to follow the annual percentage guideline. So you can still only up the rents once a year, and you just don't have to follow that 1%.
Yeah.
There's still all the laws in place, the tenant laws and everything.
Yeah, and keep in mind this is Ontario, but I think a lot of provinces have some sort of incentive to own a new build. Like I actually just found out when we were doing the Wealth Genius boot camp in Winnipeg that Manitoba, same, like, they have rent control rules as well, but if the building is less than 25 years old, it doesn't fall under rent control. So look at the different rules for your different provinces, and a lot of them have some sort of incentive that make it a bit more attractive to be buying a new build. So yes, maybe the day you're walking into it, it's not a cash cow when you're walking into it, but the ability to keep up with market, I think that's a huge incentive, because a lot of the older buildings where you're stuck with your annual rent increase and in these areas with rent control and you can't keep up with market, you can get pretty far behind. Or if you don't do a rent increase for 1 year for some reason, you can get pretty far behind what market rent is.
Yeah. So when I first started thinking about property management and having tenants and that kind of thing. My initial reaction to that was I would love to have a long-term tenant. I don't want to have to turn over a unit. I don't want to have to deal with that. Get the tenant in and have them in there for as long as possible.
It's a lot of work turning a tenant over, and you have vacancy typically,
Yeah.
right?
Usually there's some time in there where you're turning the unit over so that it's ready for the next renter.
Yeah. Even if it looks like it's not vacant, because you can be getting someone in right away, but if there's a month in between, you have a vacancy. So
yeah, but I was quick to realize, and I think somebody had mentioned it, and it kind of caught me off guard, was that they only want, and this is in Ontario again, they only want somebody in their units for 2 to 3 years max. And the reason for that is because by that time, you are now far behind what market rent is. If you're following the rent control guidelines, then you are going to fall behind very, very quickly. Mm-hmm. So this is why there's a lot of buildings that are older that are now way under market rent because they've had long-term tenants. If you have a tenant in there for 15 years, they're probably not paying over $1,000 or just close to that when rent could be $1,700 plus. Mm-hmm, mm-hmm. Yeah. So that's a huge, huge gap. And that's simply because they haven't been able to keep up with market rent.
Yeah. So a big deal for income. And I think on the other side of that as well, you think of new build, you also think of expenses, right? So when you're speaking cash flow, part of that is what you're making for income, but the other part of that is what you're paying in expenses and for your debt and that kind of stuff.
Yeah.
So, obviously the beautiful part is that you can keep up with market rents a lot easier. You can year over year, increase your cash flow in a way that's very different than if you have an older building. But the other piece of it is the expenses that you're paying.
So you have new toilets, new low flow fixtures, right? So all of a sudden you have less of a plumbing cost or a like water cost. You have less maintenance, right? Mm-hmm. Less maintenance budget because everything is newer. You have this honeymoon period where all of the appliances are new. They're going to last you probably 10 years where there's a warranty on them. If they do fail, then you have that warranty period where you're not just having to go out and buy a new appliance.
Yeah. And I think overall, even like your day-to-day expenses are going to be less because you're not going to have little random things breaking, falling apart because they're brand new. And then your big capital expenditures, like you're not going to have to replace the roof in 5 years. Big. You're not going to have to replace all the windows in 5 years. And again, this is really important that you make sure you know who built the building, because you want to make sure that they're a reputable builder that has, they've done well with their buildings and they do it properly. And because then you can run into some other issues where you do have some big expenses, but it's
because the corner of the building sunk in the first 3 years.
Yeah. So you always want to make sure that the building was well built. But if it's well built, then again, you don't have to worry about these big capital expenditures. Whereas if you're getting into an older building, yes, there can be older buildings are great for like your value add projects, your BRRRR projects, that kind of stuff, which can be incredible. But, there's boogeymen behind the walls. We've opened up a ton of old houses and, it's the same with apartment buildings. You don't know what's behind the walls when you start to take stuff down.
Basements. Old basements.
Yeah, things.
Waterproofing is
flood.
gone or was never there.
Yeah. So there's a lot of expenses that you run into that can be big ticket, and now you have to pay for those things, and there's a bigger chance of running into those things in an older building. And it's not that we're saying don't buy an older building because of these things, because you can do really well on old buildings. You can do big, beautiful BRRRR projects on older buildings. But it's just realizing that, there's a balance. Mm-hmm. New buildings, yes, they're more expensive. Yes, they're more per door, but your year over year maintenance, your capital expenditures going to be a lot less year over year. So there's benefits to both sides. Mm-hmm. And I think that comes back to a lot of what we talk to our investors about, because when you're looking at an older building versus a newer building, the returns on an older building can look really sexy.
Yeah.
right? Like
Yeah. When you're looking
projections.
at a BRRRR, right?
Yeah.
You're talking about doing a major value add lift in the first year or so,
Hmm.
and then doing a refinance and taking out a huge chunk of money because now you've increased the value to get
Hmm.
that equity.
Yeah, and I think a lot of what we talk about with investors is risk profile, because these returns can be really incredible, and you can get your money back a little bit faster because you can do the BRRRR, you can do a refinance, you can pull some of that money out, put some of that money back in your pocket. But a thing that you have to remember is that those are projections, right? That's not something that's guaranteed. If you're not able to turn the units over the way you thought you could,
Mm-hmm.
if the renovations don't go as you thought, if the valuation at the end isn't what you thought it was, especially right now,
Yeah.
people are so used to COVID times where valuations were going through the roof.
Everything
People,
was appraising for through the roof.
yep, and it's a lot more conservative now.
And lenders were lending on values that were through the
Hmm.
roof, right?
Yeah, and those valuations have changed a lot in COVID. So
Yeah.
we're not.
Lenders have pulled back. They're being a lot more cautious.
Yeah.
Appraisers realized, whoops, we made some mistakes because we way overvalued some properties. So they're actually, a lot of them are in trouble. So now they're being a lot more cautious and conservative with their numbers.
Hmm.
So they're not appraising quite as high as you would have anticipated or
Hmm.
hoped for. Remember, we're not smoking the hopium here, right?
Yeah.
And then, not to mention, if you're doing like a big value add renovation, I don't know what it is, but ever since COVID, nobody wants to work anymore. Everybody was getting free money for sitting on their couch, doing nothing, and it was hard for people to actually go out and make money because they made more sitting on their couch doing nothing. So nobody wants to work anymore. So it's actually, contractors are having a hard time finding good trades and keeping them. So there's a lot of delays on construction projects as well, which is going to majorly impact
Mhm.
your burst strategy. If you're trying to finish a project within 1 year and refi, and there's delays, then that's going to be an issue. Permitting
Yeah.
delays as well, especially in major centers.
And then things go over budget. Building materials are expensive. So this all comes down to what your risk profile is. You're going to say something.
And we're in Ontario, so what
Oh,
if your
yeah.
tenants don't leave, right?
Yes. That makes it even more tricky to add the value that you're hoping to add.
Yeah, you were reading something this morning that was saying that a tenant was able to negotiate $40,000 as basically cash for keys.
Yeah.
They negotiated $40,000 to be able to leave.
Yeah. So
Like, that's insane. How do you budget that?
there's things that, obviously they're like, we're not poo-pooing BRRRR projects. We've done them ourselves. We like BRRRR projects. But just keep in mind that there are some risks associated with that. It's not clear cut. These are uh, educated guesses, hypotheses, we'll call them, on where the
What
project's
is this,
gonna.
science class?
Yeah, it's a science class. They're good educated guesses on where the property's going to land by the end, but
Projections? Is that what you're looking for?
projections, but like, I don't know. Yes, I guess projections. I wanted a different word than that.
Okay.
But again, it comes down to what you're okay with accepting as far as a risk profile goes.
Mm-hmm.
So these big BRRRR projects, these big turnaround projects are a little bit riskier because you're not walking into the project necessarily working the way that it needs to work. You need to put some stuff into it. You need to put in the elbow grease to get it to work. And there's no guarantee, and there's no guarantee in any investing ever, but there's no guarantee that it's going to get to where it's going to go.
Mm-hmm.
And what we've seen with newer builds is that you're walking into a property that, yeah, okay, it's not giving you those big sexy returns where you're getting your money out in, a couple years, and now you own the asset and it's worth, double because of what the work you put into it. That's not what these newer builds look like. But what they do look like is you walk into something that you know is working. You're walking into something that's tenanted. You know that the roof is good. You know that the windows are good. Hopefully, it was well built because you're buying from a reputable builder. Your tenant profile is typically good. So you're taking less risk going into a new build because you're walking into it working. And the idea is that you're walking into it working, and each year it's going to get a little bit better. And each year, because you're able to increase those rents a little bit more, you're able to keep your expenses down. You're not going to be finding those boogeymen behind the walls the idea is that year over year, that's where Jeff was talking about them eventually like overperforming what those big BRRRR projects would look like because of these things, because of the risk profile being a little bit lower.
Yeah, it's just a longer term play.
Yeah, you have to have like
You need to have
vision.
a vision.
You'd have long vision for these.
Yeah. And again, this is more of a capital preservation type play versus recycling your money, right? So that's the difference in it. Like Dakota said, and the whole purpose of this isn't to poo-poo on BRRRR projects. We love them. We're doing a BRRRR project right now.
Yep.
But what have we been telling everybody on the refi period?
We've been giving like approximations
Of
after repair value. I don't know what exactly you want from me right
so
now.
We've been saying.
I don't know. I was like, I don't know. What have we been saying?
So we've been saying that we plan to do the BRRRR in 2 years.
Oh, I see.
Right. So and this is something that's going to take 6 months. Should take 6 months to do. Right.
I didn't like that quiz.
We're doing secondary. We're doing secondary dwelling unit conversions before. We've done them before. We know that we know what goes into them and how long they take. We know there's going to be permitting delays and potentially delays on the construction side as well. We also just want to make sure that everything's stabilized. So we're not going in saying we're going to be done and BRRRR'd and like all your money's back in 6 months because that's how long construction takes. No, we're saying that it's probably going to be 2 years. If it comes sooner, bonus, right? That's kind of the plan with this, and we're just not being over presumptuous with how this is gonna turn out. So it's just kind of setting the expectations. We're also in a really tough market landscape with interest rates being so high. So as soon as you refinance, you're refinancing into a higher loan at today's rates. So if interest rates are going up every month, then now all of a sudden 6 months later, your interest rates have gone up 6 times.
Yeah. So I think, again, we're not saying don't do BRRRR projects. We're not saying, oh, they're risky, like avoid them. We love BRRRR projects. We're doing them now. We still do them. They can be a great tool. I think the idea is that there are risks, benefits to both types of projects, and to just not disregard the new builds because there are
don't be scared of them.
Yeah, don't be scared of the new build because of that price tag. Understand that there are benefits and risks to both of them as there is in any type of investing. Both of them are great projects when done correctly and underwritten correctly and projected correctly, and that expectations are managed and everything with both of them. I think what we're trying to get across is just don't shy away from the new builds because there are so many benefits to them, even though, you run the numbers and they maybe not as sexy as like a BRRRR would look.
Yeah.
And some of the other things that we've seen with new builds is that some areas, like some municipalities, are even giving other incentives to buy new.
Tax breaks.
Yeah.
Yep. Property taxes were.
And this is per municipality, so this is not Ontario-wide. You'd have to check with the municipality you're purchasing in, but
there's like, I know that the very first one we got under contract, the property taxes were looked at as residential, not as commercial. So there was a huge break on the property taxes for, I don't know, I want to say the first 5 years, but I could be making that up. But there's a lot, like check your municipality wherever you're looking to purchase or to build. Make sure that you're looking to see what kind of incentives there are for you to actually do that, because we need more rentals. We need more property. So the government knows that, and they're looking to give tax breaks to people that want to put the effort in and build, because we can't build fast enough.
And if these are like, if you don't know these things and you're going into a new build, and again, you're looking at the numbers saying these numbers don't work, they don't make sense, it's because maybe you don't know about some of these
incentives.
Yeah, these incentives, these potential tax breaks, being able to increase rent without it being under rent control. It may just be that you don't realize that it's just a different product than maybe some of the older buildings that you're used to underwriting. So definitely some things to keep in mind when you're looking at a newer build. Yeah. Is there anything else? But we just really... Oh, and I guess the other thing is with new builds, everyone just loves them.
Who loves them?
Everybody loves them.
Tenants love them.
Tenants love, and again, keeping your tenants happy, people will want to stay in something that's a new build. So you're not going to have as much tenant turnover, but you can also keep them up with market. So you get the benefit of both sides of that.
Yeah. You can up the rents by 5%, whatever the market will bear, right?
And whatever your tenant, like whatever will keep your tenants still happy, but
yeah,
you want everything's a balance. You want to stay in that balance.
Yeah.
Like investors love new builds, your partners will love new builds.
Insurance loves
new builds. Lenders love new builds. The province loves new builds. The municipality loves new builds. Like everybody loves new builds. So it's
immigration loves new builds.
Yeah, like everybody. So it's a little bit easier to sell. Like it's a product that's easy to sell to, like, CMHC. You don't have to kind of fight your way through to get a CMHC product on it.
Also, your amortization is going to be based off of the economic life of the building.
That's a good point.
So if you have a new building, there's a good chance that you're going to get 40 to 50, especially if you're in a CMHC product, 40 to 50 year amortization. Mm-hmm. And what does that do to your debt servicing now, right? Your rents are a premium. Your debt servicing is lower because you have a longer amortization on this.
Yeah.
If you buy a building that's old and decrepit, well, they're probably not going to give you the longest amortization. You might be stuck with 25 year, and now all of a sudden maybe your debt servicing is even higher than what your new build is, mm-hmm. just because of that amortization difference.
Yeah. And again, a big part of, and this is something that I talked about, I think on one of the last lives that we did, and I did a post about it recently, is about what your goals are when it comes to real estate. Because with these, they might not be your cash cows from day one, but if you're an investor who, if you have a high income job, you're a high income earner, you might not want to be doing these big turnover deals where you have a bunch of cash flow or you're getting your money back really quickly and then everything is active income and you have to, put that on your tax return and now you're going to get taxed on all that money. With newer builds, they tend to be a longer play. So again, Jeff was talking about the idea of capital preservation. Yeah, it's
hedging your investment against inflation.
Yeah. And you're not going to be necessarily cash flowing like a cash cow year one, but when you go to, refinance potentially at the end of your term for your mortgage, you could be pulling out a good chunk of money and there's tax advantages to that. So this is also a different play where if you're a high income earner, putting your money into something that's a newer build might actually be a good idea so that you're not making a ton of active income, but your money is in, a relatively a safer position because of the benefits of a new build. And you're going to be in a really nice equity position as the value of the property goes up because it's brand new. It's going to be like it's still going to be new in 20 years when you go to either sell or whatever you do in 20 to 30 years. Mm-hmm. So it's a great way to kind of protect that capital in a really solid asset. So it's something to think about if you are looking to get into either passive investing, partnerships, or purchase a new build on your own. It's really nice if you're a high income earner to get into a new product to protect that capital.
Yeah.
Thoughts?
Indeed.
So again, I guess in conclusion, everything has its benefits. Everything has its risks. It's different for everybody.
Just don't be scared of new builds, I think is...
Don't pass them by. Do the underwriting, do the research. It can be a really interesting project. But yeah, birds are also great. So
yeah, the fast money is fun.
Yeah. Doing a little bit of both is, I think, great.
Well, we have a deal right now that's kind of a hybrid because they're new builds. So actually one of the buildings doesn't fall under rent control. The other one was built, I think they finished it, I want to say August of 2018. So
it was close.
It was so close to not falling under rent control, but one of them does. But it's kind of a hybrid in the sense that we were able to negotiate a really good deal on this. So there's a lot of equity built into the purchase of this, which is very rare when it comes to new builds. If you're buying directly from a builder, it's hard to buy with a ton of equity in it. But in this case, they're a little bit older, but still new. So we were able to buy with a ton of equity, and really that means that we project the capital return to investors much quicker than your typical new build.
Mm-hmm.
So it's actually, this one is really exciting that we have.
Yeah, and it's still got that attraction of being a new build where you get all the benefits of it, and that's why this is one that we've been working on for a long time, and we've stuck with it because we know that it's going to be a really incredible asset for ourselves and our partners that are involved. It's a fun one. It's definitely a fun one.
Yeah.
So of course, as always, if you ever want to know what we're up to, if you want to know how to do what we're doing, get involved in what we're doing, send us a message and we can hop on a Zoom call and chat.
Yeah.
Figure out if we can
see how
do
we
some
can be partners.
synergies there. So please reach out. Let's get on a call and we'd love to connect with you.
Yeah. So we'll be back next Tuesday. Same time.
Hopefully with more sleep next time.
12:30 Eastern time. We're still in August. We're still in August for next Tuesday, right?
Very much still in August, yeah.
Well, we might be just as tired. Every Tuesday at 12:30 Eastern time, we will be here with a new topic. If you have something that you want to hear us talk about, let us know. We appreciate everybody that tunes into these live. It will also be posted on YouTube, so you can watch this not live if you want. Just subscribe to our YouTube channel, and you'll be notified whenever we release a new video.
If you ever have a topic that you want to hear about, send us a message. And
if you want to talk with us on one of these as well, we can do that. We can bring you in. We would love to have some guests on here to talk about something that maybe we're not as knowledgeable about, and you can talk about what you like to talk about. Yeah.
So reach out.
We'd like to learn too.
Let us know if there's a topic you want to hear about or a topic you want to talk about.
Or just hear us rant about something.
Yeah. Again, if you are new, thank you for joining. If you are joining every week, which I see a couple of people in the comments that have been pretty consistent, thank you. And I'm glad that you keep coming back. I hope it's been valuable for you. And if you know anybody that would find this useful, feel free to share it with them.
Please do.
And invite them to the next one.
All right.
Until next time.
Thanks, guys.